It's time to pop the champagne. On July 14th, Bitcoin officially broke through the 120k mark. And exactly 1 year ago, same day, it was just a bit over 60k. In 1 year, it doubled, bro. It doubled. That kind of gain wipes out 99% of other assets on the market. But for retail investors, this isn't necessarily a good thing. Why? Let me break it down. I've bought Bitcoin on local Bitcoin and Bitcoin Insanity a long time ago. I've seen miners grow and then leave China, where I'm right now, by the way. I've seen this kind of runway too many times, from a few $100 all the way up to today. And I gotta say, this time it really feels different. Because this bull run, it's not driven by retail hype, like always. It's not some made-up narrative being pumped, like we saw before. Behind this time, there are a few real structural forces strong enough to push Bitcoin into a whole new historical phase. And they are also the reason why it's getting more expensive for regular people like you and me to get in. Why the window to invest is getting smaller and smaller? Today, I'm gonna show exactly what pushed Bitcoin to these new highs. 5, to be exact. And the last one, only a handful of people will really get how deep that logic goes. I'm Cédric. I've been in crypto more than 8 years. I'm an old school OG if you want. If you want to understand where this space is headed, make sure to hit the subscribe button. Alright, let's dive in. This run, it's not retail driving it. The real push is coming from those, suit and tie, Wall Street guys. Take BlackRock. Larry Fink, that guy. His high-bit Bitcoin ETF is now making more in management fees than their own S&P 500 ETF. Bitcoin isn't just an inflation hedge anymore. It's a full-blown cash flow machine. I said it before. TradFi. Folks, we're gonna regret brushing it off. And boom, now, they are not just regretting, they are scrambling to buy in. I got a friend that works at Merrill & Lynch in the US, texting me for Bitcoin advice. He was blinded by his own banks and government. The elites made him think that it was all a scam, but now the same banks are buying. Funds are buying, and they have been buying before him, getting a better price. It's unfair, but it's not just that kind of elites anymore. It's hotel groups in Mexico, traditional hotels in Japan, nail salons in Japan even. They are stacking sats. Hotel chains are buying Bitcoin for real. Why? Because that fiat cash in their books, it's turning into trash. So they are rebuilding their balance sheets. BTC is now going into their core reserve pool. It's a paradigm shift. Bitcoin is becoming a corporate grade reserve asset. Full stop. So yeah, that's the first reason. Reason 2. ARK's data couldn't be clearer. 74% of all BTC is now held by diamond hands. They are not selling. What does that mean? If you want to buy Bitcoin today, you have got to pry it out of my hands. And we are not selling. Glassnode's realized hold ratio just hit an all-time high too. That means supply is getting locked in the hands of long-term holders. Speculators are leaving. Smart money is taking control. And that structural shift, that's the trend you should really be watching. Honestly, you don't even need to understand on-chain metrics and complicated stuff. Just know this. This pump isn't driven by hype, not memes, it's just relentless accumulation from long-term players. It's that boring. And one more thing, during those few hours when BTC punched through 120k, 340 million worth of shorts got liquidated. Everyone betting against it, gone in a blink. Quick advice, never short Bitcoin, it's too risky. Anyway, it's called a technical squeeze. Speculators are quiet, but long-term capital is building quietly, brick by brick. Boring. Reason 3. I talked quickly about government when I mentioned my friend in finance in the US. Let me emphasize, it's not just institutions putting real money in. Macro is giving Bitcoin a big assist right now. First off, regulation is getting clearer. In the US Crypto Legislation Week, it's now the Clarity Act, the Genius Act, Bitcoin as a digital commodity, not a security. What does that mean? The biggest compliance barrier for big capital is disappearing. Second, tech stocks are fueling the fire. AI chips, Nvidia, they keep smashing all-time highs. That pushes up risk appetite across the board. And Bitcoin, more and more people now see it as part of the tech growth asset class. You'll notice it's moving in sync with tech stocks now. It's becoming a core asset in the future of our investment basket. Third, Capital is rotating to new safe havens. Even though rate cuts haven't officially started yet, the market's already pricing them in. When treasury yields fall and real estate freezes up, money will start hunting for something else. Assets that are flexible, 24/7 and liquid. Liquid globally. Bitcoin happens to tick all three boxes. High liquidity, global pricing, low barrier to entry. It's perfect. It's not that surprising. This is just real-world capital doing what it does best, adapting. Of course, Bitcoin's price action isn't just about demand. When Bitcoin launched in 2009, you could mine 7,200 BTC per day. Nobody really knew what it was just fun, big supply, it's cheap. But today, we are down to just 450 BTC a day, and less than 5% of all Bitcoin is still left to be mined. Miners are fighting for it. Big money is fighting too, and those coins, they get locked up. They don't even hit the market once they are mined. That means what? That means that available BTC for actual circulation is shrinking fast. OTC BTC is shrinking. There is not enough. And as I was telling you, that's one of the reasons why you don't short Bitcoin. The fundamentals tell you not to short it. Some people are not just understanding math. And look at the historical cycles. First halving in 2012, BTC went from $12 to $1,100. Second halving, it ran up to 20K. Third halving, it touched 60K. And now we are in the fourth, and just 1 year in, and we've hit 120K. You are not trading against a person anymore. You are trading against a mathematically enforced global consensus. It's math, once again. Bitcoin doesn't go bankrupt. It doesn't print more money. It doesn't randomly expand. It only gets more scarce. And human greed, it never halves. Nobody knows how high it will go, but I'll tell you this. Every time someone asks me if they should buy some, my answer is always yes. It's not financial advice for you, it's what I say to my friends, especially now. I honestly recommend owning at least 0.1 Bitcoin within the next year. Yes, 0.1. Forget owning a full one, the whole coin or thing. That ship's kinda sailed. I actually made a whole video on this already, how to stack 0.1 Bitcoin in a year with a step-by-step plan and template to DCA in a more clever way than what everyone is doing. If that interests you, you just add me on Telegram and I'll send it over for free. And then there is the invisible player. Aside from everything we already said, there is one more silent force most people haven't clocked yet. China. Back in the day, China kicked Bitcoin out. I told you about that earlier. Miners, users, everything, gone, exchanges too. And it wasn't subtle. They did it hard. But now, it feels like the wind is shifting again, quietly. Alibaba, JD.com, these are policy barometers in China. They have started applying for stablecoin-related licenses. Mining is getting back. It's not official. They talked about, data centers. And it's kind of a gray area. No company in China just wakes up and decides to launch stablecoins or start mining. Of course, this touches cross-border payments and monetary sovereignty. It's China, so it means state-level approval or even direct guidance. So yeah, it's a kind of a gray area, but don't forget China was the biggest BTC mining hub for years, and nobody really knows where all that early BTC ended up. I won't say China is back in the game just yet, but if you're asking me whether these companies are acting with government blessing, I'll just say it's very, very likely. And if stablecoins really ramp up, what's gonna back them? If the global monetary system gets rewritten, whether you are on Team USDC, USC, or trying to do your own thing, you can't escape Bitcoin. So, yeah, that's just my take. But one thing I'm sure of, no one is removing Bitcoin from the new rulebook. That's not happening. Okay, let's wrap this up. Institutions are bringing the firepower. Corporate balance sheets are expanding the vision. Policies are removing the blockers. Tech stocks are the tailwind. And behind the scenes, some serious geopolitical shifts we don't fully see yet, but we can see the shadows moving. Put those files all together and it's clear. It's a global structural revolution of Bitcoin's role. That's why my prediction of 160k BTC this year wasn't a moonboy dream. Of course, short-term dips always happen, but for anyone thinking long-term, each rational pullback might just be the best entry we'll get. Now, here is the flip side. As this goes on, retail space is shrinking. The new players are Wall Street, governments, massive corporations. For regular folks like you and me, that ticket to entry gets pricier by the day. By the day, I had a friend during last year, Black Monday, who was actually relieved he hadn't bought in. The crash we had on August 5 last year. It was crazy. But today, he's full of regret for not getting in earlier. So yeah, it's just the old meme again and again. People don't study the fundamentals and the dynamics. They just get played by their emotions. They don't have a strategy, a plan like my spreadsheets to DCA or retire on Bitcoin. They are not in control. You have to understand. So what about you? Are you still waiting or are you already in? Drop your answer in the comments. I will read them all. I'm Cédric. I'm not here to make you FOMO. I just wanted to help you keep, decode the deeper trends behind finance and crypto. And if you like that, subscribe. Hit the like button. Turn on that bell. I'll see you in the next one. Merci et au revoir.